Ticker symbol DPZ is up 7% in the past year, and today we'll be looking at a clear market leader with a very wide moat, which has a highly profitable business model. It has solid fundamentals, improving efficiency ratios, and it has one of the highest free cash flow rates I have seen with very low capex. So today we'll be looking at Domino's, a pizza franchise company. In their annual report, they say that they're the largest pizza company in the world with more than 20,500 locations in over 90 markets around the world. They mainly operate through franchise owners, but they also have some company-owned stores through the delivery and carry-out service models. So a very small part of the revenues comes from actually dining in the restaurants. And I believe something around 99% of the locations are actually franchisees instead of company-owned stores, which is great as Domino's does not have to control all the operations part of their restaurants. They just set the price, the brand, the supply chain, and the menu, and the rest of the headaches have to be handled by the franchise owners. Now, Domino's generates revenues by charging royalties or fees to franchisees, which are usually based on as an ongoing percentage of any sales that the franchisees actually generate for the use of Domino's brand marks, of their ingredients, of their menu, of anything that has to do with Domino's. This is generally how a franchise business works. And now, their business model can significantly yield cash flows to Domino's Pizza through a consistent franchise royalty payment, and it allows them to keep their capex at a minimum, which is great as it maximizes the cash flows that they're able to give back to the shareholders. Now, when we look at their financial analysis, this company shines as, first of all, they have a super impressive return on capital employed of 47%, which in this channel, just so you have an idea, our threshold of return on capital employed for a company to be a good option to invest in is 15%. And a company with 47% return on capital employed means that the management knows exactly what they're doing. Now, they have an interest coverage ratio of 4.3 times, which is not the greatest. However, since this company generates such stable revenues, cash flows, and net income, they're in a safe position even though they have a low interest coverage ratio. Now, they have a cash conversion ratio of 70% and a very, very nice profit margin of 39% and an operating margin of 19%, which is above the 15% operating margin threshold that we usually set, considering that this company is actually in the food industry, which tends to have lower margins. But now this company is extremely predictable and extremely stable. As we can see, their net income has increased about 21% year over year, but if you can see, their revenue, gross profit, and net income is extremely stable and is growing quarter after quarter, with their margins actually staying pretty consistent and even growing by a little percentage every single quarter as well. Now, when we look at their efficiency ratios, this is great as they're improving also every single quarter. Now, one thing you will notice is that the return on equity is not here, and this is because their equity is negative, but we'll talk about it later. The one we have to focus here is their return on invested capital, which again is above the 15% that we look for. Now, this is the only red flag that I have seen with Domino's Pizza, where their liabilities are way above their total assets. To me, this has always been a red flag because it basically implies that their equity is negative. Of course, what we can see here is that from 2022, their equity has stayed pretty stable and has actually improved a little bit. However, I would like to see Domino's Pizza making an effort to make their equity positive, or at least I would like to investigate why this equity is negative, because having total liabilities which are about 3 to 4 times your total assets may be very risky. And now Domino's Pizza actually got 5 out of 8 ticks for their fundamental analysis, but I do have to admit that I was a bit picky. Now, the first tick that they get is extremely consistent cash flows, which have been growing organically due to their ability to grow their revenues organically. Now, organically basically means that they do not depend on making acquisitions or conducting mergers in order to grow their revenues. It means that they can grow their revenues just by expanding their core offerings and working organically. Next, they pay a very solid dividend and they conduct share buybacks almost every year with the free cash flow that they generate. And now the most important tick that a company should get in order to be a good investment is the existing moat or competitive advantage. I assume that almost everyone watching this video knows Domino's Pizza, has heard of it, and has probably eaten their pizzas at least once in their lifetime. Now, the competitive advantage that Domino's Pizza has, I believe, it comes from the expectations of Domino's Pizza. When you're traveling or if you move abroad and you're wanting to eat, if you see a Domino's Pizza, you know exactly what that pizza will taste like. you know what the expectations are, you know more or less how much you will take, how you will feel after the pizza, because they have made it so that pizzas are extremely similar so that you can have your expectations, you know exactly what you're going to get, and you know exactly that it's going to be delicious. This inherently creates some sort of brand loyalty that is very difficult to erode and to take over by other competitors. Now, the things that I didn't like about their fundamental analysis was, first of all, the low liability risk. This company has an interest coverage ratio of 4.3 times, which is not extremely high. We usually look for companies higher than 10, so I do not believe that this is a good aspect for them. And then I don't believe that this company has a solid balance sheet because of what we spoke about earlier. They have negative equity and their liabilities are higher than their total assets, which I'm not a big fan of. Another last thing I didn't like is regarding their pricing power. To me, having pricing power is being to increase your prices every single year above inflation. And I don't think Domino's can actually do that because the majority of people that eat Domino's, I have to say, that are probably more price sensitive than others. And I believe that their companies are already sufficiently high priced in comparison to competitors. I don't think that they have the power to actually start charging higher prices, especially now that the trend of having a lot of discounts and lowering prices exists. But now they're paying a 1.31% dividend yield at a 33% dividend payout ratio, which is extremely good. But the best thing about this company is just look at the difference in the trend between the amount paid, the green line, and the dividends per share, the blue line. You can see that the dividends per share are increasing at a super fast pace in comparison to the amount paid. And this is caused by them actually buying back shares at a super aggressive rate. Now, in terms of valuation, it is trading right now at one of the cheapest valuations it has traded at in the past 4 years in terms of price to earnings ratio. But this is again because of the uncertainty that there currently is based on that pricing power. Now, in terms of free cash flow yield, they yield a 3.44%, which is higher than the 3% long-term inflation rate, meaning that this company may actually be at an attractive valuation. Now, the risk and possible challenges, the main one I see, I do have to highlight the performance of not meeting performance objectives, and this is extremely related with their ability to actually price their pizzas however they want to and not actually enter the price war or discount war game that is currently being played in the fast food industry. So I do believe that this is a big risk, but I don't think the others are even worth discussing. So before we move on, please remember, I'm not a financial advisor. This is not financial advice. Please do your own due diligence. However, I believe that this company has a very strong competitive advantage. I love their product. I love their brand. They have very consistent, predictable, and growing cash flows, and they have one of the highest return on capital employed I have seen, allowing them to create value for the investor. So overall, I believe that this is a great company and will probably be a great investment. However, they have very high uncertainty because of the industry tendencies right now. So thank you for watching. As always, this has been the Cashflow Compounder. Please join the Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.